That brings us to the multi-trillion-dollar question. Are we in an AI bubble? I mean, everyone is talking about it, right? You've got massive infrastructure spending, soaring valuations of chip makers, those relentless venture capital rounds. We really have to ask ourselves, is this a fundamental technological shift, or are we just watching a hype-driven market totally detached from reality? Well, to get to the bottom of that, let's start with a real shock to the system. 8%. Back in July 2026, the South Korean Kospi Index, which is a massive bellwether for global tech, plunged 8% suddenly, violently. It was this stark wake-up call that the whole AI infrastructure narrative might actually be incredibly fragile. Boom, bubble or build-out. So we really need to distinguish between a healthy technology build-out, a speculative boom, and, a dangerous bubble. To do that, financial experts look at something they call residual exuberance. Basically, this metric helps figure out if sky-high stock prices are driven by real, cash-flowing fundamentals or just pure hype. If a firm's market valuation significantly and persistently exceeds its model-implied fundamental value, well, that gap, that residual, is the exuberance. And right now, across the AI sector, that gap is looking awfully wide. And this is a really crucial distinction here. You can't just point at all of AI and shout bubble. Segment-level diagnosis is absolutely required. The infrastructure layer, the foundation models, the venture-backed application wrappers, they all have totally different risk profiles. A cloud provider might be experiencing a true build-out, while an AI wrapper startup, that could be highly bubble-prone. We've got to be specific. Which leads us to the physical reality of AI. Capital expenditure, or CapEx, sustainability relies entirely on evaluating useful life, utilization, power, and payback periods. Data centers are just incredibly expensive to build. The bubble risk really spikes when you have long-term financial loans backing these centers, but the economic life of the AI chips inside them is super short because the tech changes so fast. I mean, think about it. If you take out a 10-year loan for a data center, but the GPUs inside become obsolete in 2 years, you have a massive problem. Section 2, the semiconductor reality check. So, when investors actually started waking up to these long-term sustainability fears, the market reaction was brutal. Bellwethers tumbled. In that massive July sell-off, Samsung Electronics fell 9%, and SK Hynix dropped over 10%. These aren't just speculative startups. These are the foundational hardware manufacturers of the entire AI revolution. When the makers of the picks and shovels take a hit this hard, the whole gold rush shutters. Section 3, tripping the circuit breakers. The panic from that chip sell-off got so intense that the South Korean stock market literally had to pull the emergency brake. They used what's known as a circuit breaker, which is a market system that temporarily halts all stock trading to prevent panic selling during severe, sudden drops. Basically, it's a forced timeout. When a market drops too fast, humans and algorithmic trading bots can enter this crazy feedback loop of pure panic selling. The circuit breaker steps in, halts everything, and forces everyone to take a breath. Let's look at the strict phases the Kospi uses for this. Phase 1, an 8% drop halts the market for 20 minutes. Phase 2, a 15% drop triggers a second halt. And Phase 3, a 20% drop halts trading entirely for the rest of the day. Remember that 8% drop we talked about earlier? That wasn't just a bad day at the office. It was a systemic shock that triggered this exact Phase 1 emergency protocol in July. It really shows just how on edge the tech market is right now. Section 4, the enterprise cost crisis. Now, while Wall Street is panicking about stock prices, regular U.S. businesses are panicking about something much more tangible, their software bills. Just look at the sheer scale of the cost difference here. On one side, you have U.S. frontier models, the absolute cutting edge but incredibly expensive. On the other side, Chinese open-weight models. The kicker? They operate at about 1/10 the cost, 10%. If you're a startup burning through venture capital just to pay for AI tokens, that cost difference isn't a perk. It's quite literally the difference between survival and bankruptcy. Section 5, the pivot to efficiency. Because of this, businesses are ruthlessly reshaping their production routing decisions based on these new prices. Take a look at the June 2026 Vercel token volume. DeepSeek, a Chinese model, captured 22.6% of the volume, sitting right on the heels of Google's 24%. Let me be clear, this isn't developers just playing around in sandboxes. This is live production-grade workload routing.
In fact, zooming out to the wider landscape, Chinese-built open-weight models collectively processed 29% of all enterprise tokens on Vercel in June 2026. Keep in mind, that is up from just 1/9 of the total volume back in April. That is an explosive shift in market share happening in a matter of weeks, driven purely by the undeniable math of enterprise cost efficiency.
And the speed of this is wild. Lightning adoption. When Z.AI released its GLM 5.2 model, daily token volume increased 27-fold in its very first week. Teams aren't waiting for months of industry validation anymore. They are deploying these cheaper models on release day, just because the cost pressure is that intense. Flo Crivello, the CEO of the AI startup Lindy, paints a really vivid picture of this. They migrated all their traffic from Anthropic's Claude over to DeepSeek. His exact words: operating costs crashed to the ground, saving the company millions of dollars within months. When the music stops and capital gets tight, survival just means finding the cheapest model that still clears your quality bar. So what should you take away from all this? If you're running a business, here are some real enterprise tactics for AI cost management. First, you've got to audit your current model routing logic. Stop paying frontier prices for basic tasks and route non-critical tasks to the cheapest models. But, and this is absolutely crucial, you must validate data residency and compliance first. And finally, treat model selection as a recurring budget review. The whole set it and forget it mindset, yeah, that's completely over. Pricing is just way too volatile. Which leaves us with this final provocative question to ponder as we wrap up this explainer. We've seen the 8% market crashes. We've seen the desperate pivot to models that cost 1/10 the price. So is this extreme cost-cutting phase the true beginning of sustainable AI? Maybe surviving the AI boom isn't about raising endless billions at all. Maybe it's just about learning how to do the math. Thanks for joining me on this explainer. I hope this helped you map out the chaos, and whatever you do, keep your eyes on those fundamentals.